Well, maybe this time it's for real. Global equity markets make clear their tapering anxiety post Washington's provisional budget deal. The biggest drop in a month for US stocks, 2.5 month lows in Asia, and Europe also down at the open this morning. Could the taper come as early as January, or even shock horror later this month? That seems to be what markets are fretting about. Is it warranted, or is it an excuse to get some money off the table? Let's talk with Mike Gallagher, Managing Director, IDEAglobal. Morning to you, Mike.
Morning.
What do you think? Is December realistic for you?
Not really. I mean, I think the Fed would want to see more data. You've got the end-of-year sales, which the Fed would probably not want to disrupt. And you've obviously got book closing by a lot of the financial system at the end of December. So I think December is possible but unlikely. The real debate is between January and March.
All right, but no doubt for the next few weeks we are going to see a very nervous market, right?
Well, I think through until the FOMC statement, the market's going to be on the defensive. So it's going to be risk off, profit taking, where there's profits to still take from this year. So that's obviously sort of the long equity position and the short dollar position. So I think the dollar does well, equities do poorly, treasuries drift a little bit higher in yield terms.
How high does the dollar go?
Well, I think the key one is for us is dollar yen. I think the Bank of Japan is going to ease in the spring. We see a test of 103.75 coming before Christmas, and ultimately we're going to 110 is our 6-month view.
Now we're on FX. Let's talk about the S&P as well today. No one doubts that they're going to stay tough, right?
Well, I think that's the message that will come across quite clearly. The real sort of prospect is that the Swiss franc should eventually roll over, just like the yen, gold and treasuries have lost their safe haven allure. I think the Swiss franc in 2014 will lose that bid. And consequently, I think we'll see it roll off. But I think just to sort of try and help it along, I think the S&P are going to talk tough and very committed to the 124.
Interesting piece in the FT this morning, this interview with Peter Prate from the ECB and his push to drive recovery in lending. Tougher on bonds. What's the implication? Well, run us through what this is and what the implications are for government funding.
Well, I think there's two dimensions. I think the first dimension is clear that it's moral suasion from the ECB. We've now had two of the top ECB officials saying they're reluctant to provide liquidity for banks to buy government bonds. But there's also a hint in this article that the ECB asset quality review may involve a modest risk weighting for government bonds versus zero risk weighting. And that would be a real disincentive for banks to buy any further government bonds on a large-scale basis. And this is a real problem for the long end of the Italian and Spanish curves, because the domestic banks have been the large buyers over the last 18 months. Mm-hmm. And going forward, this general sort of policy from the ECB, I think, means a steeper yield curve for the likes of Italy and Spain.
All right, Mike, many thanks. In corporate news, New York Times reporting that JP Morgan and federal authorities are nearing settlements over the bank's relationship with jailed financier Bernie Madoff. Deals which could involve about $2 billion in penalties and criminal action would fault the bank for turning a blind eye to Madoff's huge Ponzi scheme. More signs that Metro's turnaround plan is working. The German retailer says it sees significant profitability for its 2013-14 period as restructuring begins to bear fruit. EBIT before special items should markedly exceed a comparative level of 1.7 billion euros from the 2012-13 period. Our reporter Angeline Ong used Starmine to gauge what this means for Metro shares going forward.
Metro's come a long way since its first ever dividend cut in March. Its shares since then have risen 54%. If you look at Starmine, it has a strong ARM score of 79, outpacing its peers. The closer the ARM score is to 100, the more likely the stock will see upward analyst revisions. Metro also scoring a high mark on earnings quality that's been improving since April last year, beating Carrefour and Ahold. And the one thing, though, to keep in mind is Metro's total liabilities to total assets, which is relatively high compared to Ahold. But otherwise, it looks like Metro's turnaround plan is taking hold.
A couple of juicy IPOs to keep an eye on. Hilton raising $2.3 billion via a share sale, making it the second biggest IPO in the US this year. Priced at $20 a share, it gives Hilton an equity value of almost $20 billion. The stock starts trading this Thursday. Over in Asia, Cinder Asset Management's shares soared by more than a third on their Hong Kong debut. It marks a major success for China's first ever listing of a bad debt management firm. Plus, it's the biggest IPO in Asia Pacific, excluding Japan, in over a year. World news: in Thailand, anti-government protesters now looking to the Thai military to help them oust Prime Minister Yingluck Shinawatra. Protesters today scaled the walls of Yingluck's government house office. They did not clash with police, but said they wanted them to leave the grounds. The leader of the anti-government protesters asked military chiefs to meet him by this evening to pick sides. The US is considering sanctions against Ukraine following scuffles between anti-government protesters and riot police in Kiev this week. US Secretary of State John Kerry spoke of his disgust. That's it. I'll leave you with our pictures of the day. A couple of pictures, seeing as we haven't given you much in the way of Christmas flavour yet. Here are a couple of Reuters photos from those famous German Christmas markets. Japan tourists eyeing one in Nuremberg. This one's a selfie from the Kudamm shopping district in Berlin.